On January 2nd, 2026, something broke in the global silver market that has never happened before in the history of modern commodity trading. While COMEX futures in New York quoted silver at $71.50 per ounce, physical bullion dealers in Tokyo and Dubai were selling 1-ounce silver coins at $130 per ounce. Let me repeat that number so it sinks in. $130 per ounce for physical silver, while paper contracts traded at $71. That's not a 5% premium you might see during temporary supply disruptions. That's not a 10% spread you might encounter in remote locations with high transportation costs. That's an 82% premium for physical metal over the official spot price, an 82% divergence between what exchanges claim silver is worth and what actual buyers must pay to obtain real metal. This has never happened before. Gold occasionally sees 5 to 10% premiums during supply crunches. Silver sometimes trades at modest premiums in specific regional markets, but an 80% systematic decoupling between paper and physical prices across entire geographic regions, representing billions of dollars in daily transactions, that's a market failure of historic proportions. The lie isn't subtle, it's not hidden in footnotes or buried in technical jargon. It's staring everyone in the face within $60 per ounce gap between what Wall Street's exchanges claim silver is worth and what the physical market proves it's actually worth. And that gap is widening rather than closing because the arbitrage that should eliminate such discrepancies cannot function when there isn't enough physical metal to move. Let me explain how commodity markets are supposed to work in theory versus what's actually happening in practice. In an efficiently functioning global market, geographic price differences should be minimal and temporary. If silver trades at $71 in New York and $85 in Shanghai, arbitrage traders should immediately buy in New York, ship to Shanghai, and sell at the higher price. That arbitrage activity serves two critical functions. It generates profit for the traders executing it, and it equalizes prices across markets by increasing supply in high-price regions and reducing supply in low-price regions. The process continues until prices converge at a level that reflects transportation costs, insurance, and financing expenses. Maybe a $2 or $3 spread to account for those factors. Not $14, definitely not $60. But that arbitrage isn't happening. The spread persists and grows larger because when traders attempt to pull physical silver out of COMEX vaults to ship east, they discover there isn't sufficient available metal to execute the arbitrage at scale. The vault inventories that supposedly back paper contracts are encumbered by existing claims, locked into ETF holdings, or simply don't exist in the freely tradable quantities that open interest suggests. This is the fundamental lie at the heart of modern commodity markets. Exchanges sell paper contracts representing claims on physical metal. Those contracts trade at prices determined by leveraged speculators, algorithmic systems, and financial flows that have nothing to do with actual supply and demand for physical metal. And everyone pretends these paper prices represent reality. For decades, this system worked adequately because industrial users could generally convert paper positions to physical delivery when needed. The fractional reserve nature of commodity exchanges wasn't a problem because most traders close positions before delivery, and the minority demanding physical metal could be satisfied from vault stocks or spot market purchases. That equilibrium just shattered. Industrial users now demand physical delivery in quantities that exceed available supplies. The paper market continues trading as if nothing changed, with futures prices reflecting financial conditions and speculative positioning rather than physical scarcity. And the gap between paper fiction and physical reality grows wider every day. The Shanghai Gold Exchange provides the clearest evidence of this divergence. Throughout late December 2025, physical silver on the SGE consistently traded at $8 to $20 premiums over COMEX futures prices. Chinese buyers offered foreign suppliers $8 per ounce above COMEX spot just to secure metal. That premium reached $20 during periods of acute shortage. The SGE operates differently than Western exchanges. It facilitates actual physical trading and delivery rather than primarily cash-settled futures. When you buy silver on the SGE, you're buying real metal that gets transferred from seller's vault to buyer's vault. The benchmark prices reflect what parties are willing to pay for deliverable physical silver rather than what speculators think futures contracts should trade at. This makes the SGE premium incredibly revealing. It tells you what silver is actually worth to end users who need the metal for industrial production, wealth preservation, or strategic stockpiling. And that real-world value is 10 to 28% higher than Western paper prices depending on which day you examine. The situation in Japan became even more extreme. On secondary market platforms like Mercari, retail premiums for physical silver coins and bars surged to approximately 60% above spot prices during peak demand periods. 1-ounce silver coins that should theoretically cost $72 to $75, including modest fabrication premiums, were selling for $115 to $125 when available at all. These aren't isolated incidents in exotic backwater markets. Japan is the world's third largest economy with sophisticated financial markets and efficient logistics infrastructure. If physical silver commands 60% premiums in Tokyo, that signals global supply chain breakdown rather than local market dysfunction. Dubai presents perhaps the most shocking data point. In the United Arab Emirates, physical bullion dealers were transacting at $130 per ounce on January 1, 2026, when COMEX spot sat at $72. That's not a premium. That's a completely different market trading at a completely different price level with no connection to Western paper benchmarks. The UAE is a major precious metals trading hub with sophisticated refining capacity and strong connections to both Western and Eastern markets. It sits at the geographic crossroads of global commodity flows. The fact that silver trades at $130 in Dubai, while COMEX quotes $72 in New York, proves the paper market has lost credibility and price discovery is shifting to physical markets. This bifurcation creates two separate silver markets that increasingly don't communicate with each other. The paper market in New York and London, where contracts trade based on financial conditions, margin requirements, and speculative positioning. And the physical market in Shanghai, Tokyo, Dubai, and other Asian centers, where real metal changes hands based on actual supply scarcity and industrial necessity. Eventually, one of these markets must give way. Either paper prices rise dramatically to reflect physical scarcity, or paper contracts become completely disconnected from physical reality and cease to function as meaningful price discovery mechanisms. History and basic economics suggest paper eventually reprices to physical rather than the other way around. The COMEX inventory situation provides crucial context for understanding why this divergence is occurring. Registered silver stocks available for immediate delivery have plummeted from approximately 140 million ounces in early 2021 to under 45 million ounces by January 2026. That's a 68% decline in deliverable inventory over 5 years. Meanwhile, open interest in silver futures represents claims on approximately 675 million ounces. Simple mathematics reveals the problem. Outstanding contracts represent claims on 675 million ounces, while registered stocks contain only 45 million ounces available for delivery. That's a ratio of 15 to 1. 15 ounces of paper claims for every ounce of actual silver that could theoretically be delivered. Under normal conditions, this fractional reserve system functions because most contracts get closed or rolled forward rather than stood for delivery. But these aren't normal conditions. Industrial users who previously sourced silver through dealer networks and spot markets now attempt to secure supplies through COMEX delivery because traditional channels are disrupted by Chinese export restrictions and inventory depletion. December 2025 saw delivery demands approach 65 million ounces, the highest level in exchange history. The COMEX struggled to fulfill these demands, leading to rumors of cash settlements offered to contract holders in lieu of physical delivery. Those rumors are difficult to verify definitively, but the persistent physical premiums in Asian markets suggest delivery problems are real rather than speculative. If contract holders increasingly doubt their ability to obtain physical metal through COMEX delivery, they'll bid up physical premiums in spot markets to secure supplies through alternative channels. That's exactly what the data shows happening. The paper market maintains the fiction of orderly trading, while the physical market screams scarcity through unprecedented premiums. The London Bullion Market Association faces similar dynamics. LBMA vault holdings declined approximately 40% from 2020 levels, falling from over 1 billion ounces to around 620 million ounces by late 2025. London operates primarily as a wholesale physical market rather than a futures exchange, so inventory declines directly impact available trading supply. London's silver price traditionally served as the global physical benchmark, determined through twice-daily auctions among major dealers. But that benchmark increasingly reflects paper market dynamics rather than physical scarcity, as trading has become more financialized over recent decades. The disconnect between LBMA's published spot price and the actual prices paid for immediate delivery in Asian markets demonstrates the problem. Market participants now distinguish between LBMA spot price, which represents theoretical paper transactions, and physical premiums, which represent what you actually pay to obtain real metal. This two-tier pricing structure is exactly what preceded the breakdown of the London gold pool in 1968, when Western central banks could no longer maintain the official $35 gold price in the face of overwhelming physical demand. That historical parallel is instructive. The London gold pool was an agreement among major central banks to supply gold to the market at $35 per ounce to suppress prices and maintain confidence in the Bretton Woods monetary system. For years, they succeeded through coordinated intervention. Then French demands for physical delivery, combined with rising inflation expectations, overwhelmed the pool's capacity to supply metal at official prices. The pool collapsed in March 1968. The official 35 gold price was maintained for government transactions, while a free market price emerged for private transactions. That free market price immediately jumped to $42 and continued rising to $180 by 1974 and $850 by 1980. The attempt to suppress prices through paper manipulation failed when physical demand exceeded available supplies. Today's silver market exhibits similar dynamics. Western exchanges maintain paper prices through futures trading, margin requirements, and position limits designed to manage volatility. But physical demand from industrial users and strategic buyers exceeds available supplies at those paper prices. The system maintains the fiction until physical delivery demands force recognition of reality. China's export restrictions that took effect January 1, 2026, accelerated this process dramatically. Beijing effectively ring-fenced 60 to 70% of globally traded refined silver for domestic use through strict licensing requirements. Western markets that had relied on Chinese refining capacity and export flows suddenly faced acute shortages with no quick alternative. Industrial users in Germany, Japan, South Korea, and elsewhere who maintained lean inventories based on just-in-time delivery from Chinese suppliers now panic buy available supplies at any price. This creates the feedback loop visible in physical premiums. Buyers bid up prices to secure scarce supplies. Higher physical prices make paper contracts at lower levels increasingly disconnected from reality. More users attempt COMEX delivery or direct physical purchases. Available supplies shrink further. Premiums widen. The solar industry provides a perfect example of this dynamic. Solar panel manufacturers require silver for every unit produced. A typical panel contains approximately 1 ounce of silver that cannot be economically substituted with inferior alternatives. When a manufacturer in Germany loses access to Chinese silver supplies, they face a simple choice: pay premium prices to secure alternative supplies or shut down production lines. Most manufacturers pay the premium because shutting down production destroys profitability, breaches customer contracts, and risks permanent loss of market share. This price inelastic demand is exactly why industrial users are paying $85 to $130 per ounce in physical markets, while COMEX maintains the fiction of $72 prices. The same dynamic applies to electric vehicle manufacturers, defense contractors, semiconductor fabs, and medical device companies. All require silver for critical applications. None can easily substitute alternatives. All must secure supplies to maintain production, and all are discovering that actual availability costs far more than paper prices suggest. This creates an information asymmetry that benefits those who understand it and punishes those who don't. If you're a financial trader looking at COMEX futures prices, silver looks expensive after rallying 140% in 2025. You might consider selling or avoid buying based on apparent overvaluation. But if you're an industrial user looking at actual procurement costs in physical markets, silver looks like it's heading dramatically higher because you can't obtain sufficient supplies at current price levels. The Wall Street lie is maintaining this illusion that COMEX prices represent reality while physical markets prove otherwise. Financial media dutifully reports COMEX quotes as the silver price without acknowledging the massive divergence from actual transaction prices in physical markets. Analysts publish research based on futures market data without investigating whether those prices reflect genuine supply-demand balance. This willful blindness serves the interests of large financial institutions with short positions in silver derivatives. If paper markets acknowledge the physical supply crisis, futures prices would need to rise dramatically to reflect reality. That would generate massive losses for banks and trading houses that sold forward production, hedged mining operations, or speculated on price declines. Maintaining low paper prices through continued futures trading creates an appearance of normalcy even as physical markets scream emergency. It allows shorts to gradually cover positions without triggering the explosive price spike that would occur if the full magnitude of physical shortage was immediately reflected in futures prices. But this strategy has a limited shelf life. Eventually, delivery demands or industrial user desperation forces price recognition. The question is whether that adjustment happens gradually through rising futures prices over months or explosively through a short squeeze when COMEX cannot fulfill delivery obligations at current price levels. The backwardation in London's silver market provides another warning signal. Backwardation occurs when near-term delivery prices exceed future delivery prices, indicating immediate scarcity. Normally, commodity markets trade in contango with future prices higher than spot to reflect storage costs and financing charges. Silver entered backwardation in London during late December 2025, with spot prices higher than 3-month forward prices. This inverted price structure signals that market participants value immediate delivery more than future delivery, because they doubt future availability or need metal urgently for production. Backwardation typically precedes explosive price moves in commodity markets as it reveals genuine physical tightness. The lease rates for silver in London spiked to levels not seen since the 2011 crisis. When you lease silver, you're borrowing physical metal from someone who owns it, typically paying a small percentage fee for the privilege. Rising lease rates indicate growing difficulty borrowing metal as holders become reluctant to lend for fear they won't get it back or will miss better opportunities. In late December 2025, one-year silver lease rates surged above 20% annualized in London. That means parties desperate to borrow silver for industrial use or short covering were willing to pay 20% annual interest just to obtain temporary access to physical metal. That's not a normally functioning market. That's acute stress bordering on systemic failure. Contrast these physical market signals with the relative calm in futures trading on COMEX. Yes, prices rose substantially in 2025. Yes, volatility increased with the late December flash crash, but the market continued functioning with orderly trade execution, margin calls processed normally, and no widespread defaults or delivery failures requiring exchange intervention beyond increased margin requirements. This disconnect reveals the paper market's fundamental purpose. It's not actually about price discovery or efficient allocation of physical resources anymore. It's about providing a trading venue for financial speculation while managing that speculation through circuit breakers, margin requirements, and position limits that prevent the market from accurately reflecting physical reality. The $10,000 silver reference in the title deserves explanation. It's not a near-term price forecast. It's an illustration of how disconnected paper prices are from the actual cost of securing adequate supplies if physical shortage continues deteriorating. If industrial users in aggregate need 1.24 billion ounces annually and available supply totals only 900 million ounces after Chinese export restrictions, the market clearing price must rise until demand is rationed to match available supply. How high must prices rise to destroy 340 million ounces of demand? There's no precise answer because it depends on how demand responds at various price levels. But consider that solar, EV, and defense applications are extremely price inelastic. These users will pay dramatically higher prices before substituting inferior alternatives or reducing production. If price must rise to $200 per ounce to ration demand to available supply, paper markets currently underpricing silver by nearly 200%. If equilibrium price is $500 per ounce, the underpricing is nearly 600%. The $10,000 figure represents the logical extreme if paper market manipulation continues while physical scarcity intensifies until the system breaks completely. That extreme scenario might never materialize because market mechanisms would likely force price adjustment before reaching such levels. But the directional logic is sound. Paper prices substantially understate the true cost of securing adequate physical supplies in a structurally deficient market with declining inventories and export restrictions on 70% of refined supply. The proof mentioned in the title exists in publicly available data for anyone who cares to examine it. COMEX inventory reports show the 68% decline in registered stocks. Shanghai Gold Exchange data shows persistent physical premiums of $8 to $20. Reports from dealers in Tokyo and Dubai document transaction prices far above COMEX quotes. LBMA lease rates and backwardation are published daily. None of this is secret or controversial. It's simply ignored by mainstream financial analysis that accepts COMEX futures as representing reality. This willful ignorance cannot persist indefinitely. At some point, the accumulation of evidence forces recognition, either through a delivery failure that exposes COMEX's inability to satisfy physical demands at published prices, or through industrial users publicly acknowledging they pay substantially higher prices than futures quotes suggest, or through Asian exchanges formally establishing price benchmarks that diverge so dramatically from Western quotes that the fiction becomes unsustainable. When that recognition occurs, the repricing will be violent. Decades of price suppression through paper market manipulation have created a coiled spring of pent-up physical demand. Industrial users maintained lean inventories because they trusted supply chains and believed COMEX prices reflected true availability. Both assumptions proved wrong. Now they're scrambling to secure supplies they should have stockpiled years ago when prices were genuinely low. Investment demand adds accelerant to this fire. As the divergence between paper and physical prices becomes more widely understood, investors will lose confidence in paper vehicles like futures and unallocated storage accounts. They'll demand physical delivery or allocated storage with segregated bars they can audit. This shift from paper to physical investment vehicles directly competes with industrial users for the same scarce supplies. The silver ETFs present particular risk in this environment. Funds like SLV claim to hold physical silver, backing their shares, and periodic audits verify those holdings exist, but the silver is unallocated, meaning specific bars aren't assigned to specific shareholders. The trust owns a pool of metal stored in authorized vaults, and shareholders own fractional interests in that pool. Under normal conditions, this works fine. But if shareholders lose confidence and demand redemptions en masse, the trust must sell silver to fund those redemptions. That selling pressure could temporarily depress prices even as physical premiums widen. More perniciously, if vault operators face their own liquidity problems or physical delivery demands, the trust might struggle to access metal supposedly held in its name. These concerns aren't merely theoretical. The experience of gold ETFs during the March 2020 COVID panic provides precedent. Significant discrepancies emerged between ETF share prices and net asset value as physical gold became difficult to obtain and transport. Premiums spiked for physical gold, while ETF shares briefly traded at discounts to NAV because investors doubted their ability to convert shares to metal. Silver's smaller market and more acute supply shortage suggests even more severe dislocation is possible. If industrial users compete with investors for supplies while Chinese exports remain restricted and COMEX inventories continue declining, something must break. Either prices rise explosively to ration demand, or delivery failures cascade through the system, forcing exchange rules changes and cash settlements. The historical precedent from 1980 offers lessons about how these situations resolve. When silver approached $50 per ounce in January 1980, COMEX changed the rules mid-game. They implemented Silver Rule 7, which restricted trading to liquidation orders only. New buyers were prohibited from entering the market, only existing longs could sell. This regulatory intervention destroyed liquidity and triggered a crash from $50 to $10 within months. That crash didn't occur because fundamentals deteriorated or supply suddenly increased. It happened because exchange officials panicked about systemic risk from short covering and changed the rules to protect members with large short positions. The lesson is that exchanges will protect themselves and their major participants, even if it means destroying price discovery and market integrity. Today's situation differs in important ways. The physical supply shortage is more severe and structurally driven by industrial demand rather than speculative hoarding. Chinese export restrictions create supply constraints that exchange rules can't override, and global market fragmentation means Asian physical markets can continue trading even if COMEX suspends or restricts activity. But the risk of regulatory intervention remains. If silver prices spike too quickly, threatening major bank solvency or financial system stability, authorities will intervene. That intervention might take the form of increased margin requirements to force liquidation, position limits to restrict large holders, or even suspension of physical delivery in favor of cash settlement. Any such intervention would accelerate the shift from paper to physical price discovery. If Western exchanges prevent physical delivery or restrict trading, industrial users have no choice but to source supplies entirely through physical spot markets in Asia or dealer networks willing to transact at real market prices. That would complete the bifurcation and permanently relegate COMEX to the status of financial casino, disconnected from physical commodity reality. The lie isn't that prices are rising. The lie is that paper prices represent what silver actually costs in the real world, where industrial users need physical metal delivered to factories. That lie is being exposed in real time through the unprecedented divergence between COMEX futures and physical market transaction prices. Wall Street has every incentive to maintain this fiction as long as possible, but physical reality has a way of asserting itself regardless of financial market preferences. Industrial users either obtain supplies at prices necessary to secure them, or they shut down production. Asian markets either continue functioning at real price levels, or Western manufacturers relocate to access those supplies. And COMEX either reprices to physical reality or becomes irrelevant as price discovery shifts east. The reset is happening now. The $10,000 figure represents the logical endpoint if physical shortage continues intensifying while paper markets maintain their fiction. We likely won't reach that extreme because market mechanisms will force adjustment first. But the directional move from $75 toward triple digits and potentially beyond is not speculative fantasy. It's mathematical necessity given supply-demand imbalance and the massive divergence between paper fiction and physical reality. The proof is in the premiums. When physical silver trades at $130 while paper quotes $72, believe the physical market. It's telling you what silver actually costs when you need real metal rather than a contract promising future delivery that may never occur.